SoFi Technologies, trading under the ticker SOFI, is currently priced at $28.04, reflecting a minor decrease of 0.36% or $0.10. This price action comes as the market digests a flurry of recent developments and weighs the future trajectory of this ambitious fintech player. While the immediate price movement might seem underwhelming, it belies a much deeper and more complex narrative that is unfolding for the company. The expectation in the market has long been that SoFi is on a clear path to disrupting traditional banking, a narrative fueled by its rapid member growth and expanding product suite. However, the reality is far more nuanced, involving a delicate balancing act between aggressive expansion, the quest for sustained profitability, and navigating an increasingly competitive and uncertain macroeconomic landscape. The common belief is that SoFi's all-in-one digital banking app is an unstoppable force, attracting a younger demographic disillusioned with legacy financial institutions. This is not entirely wrong. The company has demonstrated impressive growth in its member base and product adoption. But to truly understand the current state of SoFi, we need to look beyond the surface-level growth metrics. The real story lies in the less discussed operational shifts and strategic decisions that will ultimately determine if the company can translate its user growth into long-term sustainable value for shareholders. For instance, the recent rollout of Options Level 1 trading on the SoFi Invest platform is a significant, yet perhaps underappreciated move. It's not just about adding another feature, it's about deepening user engagement and increasing the lifetime value of each member. This is a critical step in transitioning from a high-growth, cash-burning fintech to a mature, profitable financial institution. Many investors may still be looking at top-line growth, but the subtle yet significant enhancements to their platform, like the recent partnership with BlackRock for their robo-advisor, are where the real long-term potential is being built. In recent trading sessions, SoFi's stock has exhibited a degree of volatility, reflecting the broader market sentiment and sector-specific pressures. The average daily trading volume has been consistently high, indicating significant investor interest and active debate about the company's valuation. Institutional activity has been particularly noteworthy, with a mix of large funds increasing their positions while others have trimmed their holdings. This divergence of opinion among institutional investors underscores the central tension in the SoFi story: the believers in its long-term disruptive potential versus those who remain cautious about the near-term challenges. The upcoming Q3 2025 earnings call, scheduled for October 28th, is a highly anticipated event that will provide a crucial data point for both camps. Investors will be keenly watching for continued strong revenue growth, but more importantly, they will be scrutinizing the company's path to profitability and any commentary on the macroeconomic outlook. Concerns about a potential pullback after the stock's recent run-up are not unfounded, and any signs of slowing momentum could be met with a swift market reaction. SoFi's business model is a key differentiator in the crowded fintech space. It operates across three core segments: lending, technology platform, and financial services. The lending segment, which includes personal loans, student loans, and home loans, has historically been the company's primary revenue driver. The technology platform, which includes Galileo and the recently acquired Technisys, provides the infrastructure for other financial institutions and is a key part of SoFi's long-term strategy to become the AWS of fintech. The financial services segment encompasses a broad range of products, including SoFi Money, checking and savings accounts, SoFi Invest, including stock and options trading, SoFi Credit Card, and insurance products offered through partnerships. This diversified approach is designed to create a financial services flywheel, where members are drawn in with one product and then cross-sold on others, increasing their engagement and lifetime value. The acquisition of a bank charter in early 2022 was a pivotal moment for SoFi, allowing it to hold deposits and fund loans at a lower cost, a significant competitive advantage over non-bank fintechs that rely on more expensive funding sources. This has been a major contributor to their impressive net interest margin, which is nearly triple that of many traditional banks. Looking at the competitive landscape, SoFi is not operating in a vacuum. It faces intense competition from a variety of players, including traditional banks that are investing heavily in their digital offerings, other fintechs like Robinhood and SoFi, and even large tech companies that are increasingly encroaching on the financial services space. However, SoFi's integrated all-in-one platform provides a compelling value proposition for consumers who are looking for a more seamless and user-friendly banking experience. The company's focus on building a strong brand and fostering a sense of community among its members is another key differentiator. The land and expand strategy has proven to be effective, with a high percentage of new members adopting multiple products within a short period. This deepens the customer relationship and creates a stickier ecosystem that is more resilient to competitive pressures. Comment below with your thoughts on which competitor you think poses the biggest threat to SoFi's long-term growth. The future outlook for SoFi is a complex tapestry of significant opportunities and potential risks. On the one hand, the company is well positioned to capitalize on several long-term trends, including the ongoing shift to digital banking, the growing demand for personalized financial services, and the increasing importance of financial wellness. The expansion of its product offerings, including the recent foray into private markets and alternative funds, opens up new avenues for growth and revenue diversification. The continued integration of Galileo and Technisys has the potential to create a powerful vertically integrated banking technology stack that can be a major growth engine for the company. On the other hand, SoFi is not immune to the broader macroeconomic environment. Rising interest rates could impact loan demand and credit quality, while a potential economic downturn could lead to an increase in loan delinquencies. The company's high valuation multiples compared to some of its peers also create a degree of risk, as any missteps or a failure to meet lofty growth expectations could be punished by the market. Regulatory scrutiny of the fintech sector is another wild card that could impact SoFi's operations and growth trajectory. In conclusion, the narrative surrounding SoFi Technologies is a compelling one, but it is far from a simple story of inevitable success. The expectation of a fintech upstart completely upending the established financial order is a powerful one, but the reality is that SoFi is navigating a complex and challenging path. The company has made significant strides in building a comprehensive financial services platform and has a clear vision for its future. However, it now faces the critical task of translating its impressive user growth into sustainable profitability, all while fending off intense competition and navigating an uncertain economic environment. The next few quarters will be crucial in determining whether SoFi can live up to the high expectations that have been set for it. The stock's recent performance is a reflection of this uncertainty, and investors will be closely watching for signs that the company is on track to deliver on its long-term promise. The tension between the bullish and bearish case is what makes SoFi such a fascinating and closely watched stock, and the upcoming earnings report will undoubtedly add another chapter to this unfolding story. The content shared here is for educational purposes only and should not be considered financial advice. Always consult with a qualified financial advisor before making any investment decisions. If you found this helpful, please like, comment, and share to support the community.